What if I told you that a group of 12 people sitting in a room in Washington, D.C. could crash the stock market, tank Bitcoin, make your mortgage payments skyrocket, and send shockwaves through every economy on Earth, all by changing a single number? Welcome to the most powerful lever in global finance: Federal Reserve interest rates. The Federal Reserve, or the Fed, is America's central bank. But calling it just a bank is like calling the sun just a light bulb. The Fed controls the money supply of the world's largest economy. At its core is the Federal Open Market Committee, or FOMC, 12 voting members who meet 8 times a year to make the most anticipated announcements in finance. Their tool? The federal funds rate. This is the interest rate banks charge each other for overnight loans. Sounds boring, right? But this single rate ripples through everything you touch financially. Think of interest rates as the price of money. When rates are low, borrowing is cheap. Businesses expand. People buy homes, and the economy heats up. When rates are high, borrowing becomes expensive. Spending slows down, inflation cools off, but so can growth. Here's the key insight. The Fed raises rates to fight inflation and lowers rates to stimulate growth. They're constantly walking a tightrope between a booming economy and runaway prices. Every percentage point matters. A 1% change in rates affects trillions of dollars in loans, mortgages, and investments worldwide. Let's start with bonds, the most directly affected market. There's a golden rule in finance: when interest rates go up, bond prices go down. And vice versa. Why? If you hold a bond paying 3% and new bonds offer 5%, your old bond is worth less. Simple supply and demand. U.S. Treasury bonds are considered the safest investment on Earth. When the Fed moves rates, global bond markets follow. We're talking about a $60 trillion U.S. bond market, and over $130 trillion globally. In 2022, when the Fed raised rates aggressively, the bond market had its worst year in decades. Long-term Treasury bonds lost over 30% of their value. The stock market has a love-hate relationship with interest rates. Low rates are like oxygen for stocks. Cheap borrowing means companies can expand, investors seek higher returns in equities, and valuations soar. High rates? That's when things get interesting. Growth stocks, like tech companies, suffer most because their future profits are worth less when discounted at higher rates. Value stocks and dividend payers often hold up better. Banks can actually benefit from higher rates through wider lending margins. Look at 2022. The Nasdaq dropped nearly 33% as the Fed raised rates from near zero to over 4%. Meanwhile, 2023 saw a massive rally when investors bet on rate cuts ahead. Now let's talk about your wallet. Interest rates touch almost every financial decision you make. Mortgages are the big one. When the Fed raised rates in 2022, mortgage rates doubled from 3% to over 7%. On a $400,000 home, that's an extra $1,000 per month in payments. The housing market froze. Sellers wouldn't sell because they'd lose their low-rate mortgages. Buyers couldn't afford the new rates. Home sales dropped to 30-year lows. Credit cards, auto loans, and personal loans all follow. The average credit card rate jumped from 16 to 21%. That expensive new car got even more expensive to finance. Precious metals and crypto feel the ripple effects too. Gold has an inverse relationship with interest rates. When rates rise, holding gold, which pays no yield, becomes less attractive. But gold also thrives during uncertainty, so the relationship is complex. Crypto is particularly sensitive to rates. Bitcoin and other digital assets are considered risk-on investments. When rates rise and safe assets offer real returns, investors flee from risky assets. In 2022, Bitcoin crashed from $69,000 to $16,000 as the Fed hiked rates. The correlation was unmistakable. The Fed's power extends far beyond American borders. When U.S. rates rise, the dollar strengthens. Foreign investors flood into dollar-denominated assets for those higher yields. This creates chaos for emerging markets. Countries with dollar-denominated debt suddenly owe more in local currency. Brazil, Turkey, Argentina, all feel the squeeze. The carry trade unwinds. Investors who borrowed in low-rate currencies to invest in high-rate ones rush to cover positions. Currency markets swing wildly. Even the European Central Bank and Bank of Japan are forced to respond. The Fed doesn't just control the U.S. economy, it influences the entire global financial system. So how does the Fed actually make these decisions? The FOMC includes the 7 Fed governors plus 5 rotating regional bank presidents. They meet 8 times a year, though emergency meetings can happen. Before each meeting, members receive the Beige Book, a report on economic conditions from all 12 regional Fed banks. Members are classified as hawks or doves. Hawks prioritize fighting inflation even if it hurts growth. Doves prioritize employment and growth even if it risks inflation. The vote happens, and the decision is announced at exactly 2 p.m. Eastern on meeting days. The Fed chair holds a press conference where every word is analyzed for signals about future policy. Markets can swing wildly on a single phrase. The Fed watches several key economic indicators. Understanding these helps you predict their moves. CPI, the Consumer Price Index, measures inflation directly. The Fed targets 2% annual inflation. Above that, expect rate hikes. PCE, Personal Consumption Expenditures, is actually the Fed's preferred inflation gauge. It's broader and adjusts for consumer behavior changes. The unemployment rate is equally crucial. The Fed has a dual mandate: stable prices and maximum employment. Too low unemployment can fuel inflation. GDP growth tells the overall economic story. Strong growth with low inflation? Perfect. Strong growth with high inflation? Time to raise rates. The yield curve is a warning signal. When short-term rates exceed long-term rates, that's an inverted yield curve, historically predicting recessions. History offers powerful lessons about Fed decisions. The Volcker Shock, 1980 to 1982. Fed Chair Paul Volcker raised rates to an almost unbelievable 20% to crush double-digit inflation. It caused a brutal recession but broke the back of inflation for decades. The Greenspan Put, 1987 to 2006. Alan Greenspan kept rates low and cut aggressively during crises. Critics say this encouraged excessive risk-taking. The 2008 The Fed slashed rates to zero and introduced quantitative easing, buying trillions in bonds to pump money into the system. Unconventional times required unconventional measures. COVID-19, 2020. Emergency rate cuts to zero again. Massive stimulus prevented economic collapse but arguably contributed to the inflation that followed. The 2022 to 2023 hiking cycle. The fastest rate increases in 40 years, from 0 to 5.5% in 18 months. The Fed was behind the curve on inflation and had to catch up fast. Federal Reserve interest rates are more than just numbers. They shape the value of your savings, the cost of your dreams, and the health of the global economy. Understanding how rates work gives you an edge. You can anticipate market moves, make smarter financial decisions, and see the connections that most people miss. The next time the Fed announces a rate decision, you'll know exactly what's at stake. If you found this valuable, hit subscribe and the notification bell. We break down complex financial topics so you can make smarter money moves. Thanks for watching, and please subscribe for more content.